to prevent a crash landing because as soon as it sees the economy coming in for a landing, it's going to cut rates and assure that the landing is soft. Now, I think this is at best wishful thinking. I don't think this is going to happen. First of all, I think we're going to have a hard landing regardless.
Today, we delve into the puzzling dichotomy of rate cuts amidst economic conditions. Are these anticipatory measures or wishful thinking? Join us as Peter dissects the signs, the Fed's strategy, and the impending economic trajectory. Stay tuned for an eye-opening discussion on whether these cuts can cushion a potential economic descent or if a hard landing is inevitable.
Well, everything continues to be awesome on Wall Street now that investors are convinced that the Fed has finished raising rates. But more than that, it's not just that the Fed is not going to hike rates anymore, it's that it's going to start cutting rates next year. And so the markets are excited because their drug pusher is going to be showing up with more supply. You know, they've been away from the drug for a while. The Fed's been hiking rates, and that's not what the markets want. But now the markets are convinced that exactly what they need is going to be supplied as early as next year. And so you're seeing that. The averages, the last podcast I did, the markets were up. They continued to rise on the week. The stars, again, the small cap, Russell 2000 was up about 5.5% on the week. That's about the same percentage gain that the gold stocks had. They finally came back from the dead, although, you know, if you look at a chart, they've barely resurrected. They have a long way to go, but they had a good week. Gold itself was up about $40 on the week, again, on the idea that the Fed is finished raising rates. The broader stock market, not as strong. I think, you know, the major averages may be up about 2% on the week. Bond yields continue to slip. The yield on a 10-year Treasury back down at 4.44, 30-year at 4.6. So the yield curve steepening a little bit. And the dollar continues to fall. It didn't collapse, but it was down again on the week. In fact, we closed below the 104 handle. We're at 103.88. This is the lowest close for the dollar index since, you know, I talked about the reversal week that we had a few weeks ago when the dollar index was above 107. Now we're beneath 104, but we still have a long way to go. Now, the narrative, though, that is really responsible for the optimism is not only the belief that the Fed is going to cut rates next year, but that we're going to avoid recession. We're going to have a soft landing. And so this is the best of both worlds. We get the rate cuts, but we also don't get the recession. Now, you might think that those two views are inconsistent because why is the Fed going to be cutting rates as soon as next year if the economy's not in recession? Well, maybe what investors are thinking is that at a sign, or we've already got signs, and we've got a lot of signs now in the labor market and a lot of other data that have been coming out weaker than expected. Maybe what the markets are thinking is that rather than waiting to see the whites of recession's eyes, the Fed will start firing its rate cuts in order to preempt that recession. So to prevent a crash landing, because as soon as it sees the economy coming in for a landing, it's going to cut rates and assure that the landing is soft. Now, I think this is at best wishful thinking. I don't think this is going to happen. First of all, I think we're going to have a hard landing regardless of what the Fed does. But it will be even harder if the Fed doesn't cut rates. I mean, if it starts cutting rates, it'll try to soften the blow. But what's amazing to me is that you've got so many people who are looking at this situation where rates have gone from 0 to above 5%. And they somehow think that we could get away without having a recession. Because soft landing means that we don't have a recession, right? We just have a slowdown. Well, why would that be? Because if you look at the recent experiences with the Fed having rates too low and then raising them go back to the late 1990s and the decline we had in the economy, the recession, the stock market in 2000, 2001. Look at the experience in 2008. And look at what happened even before COVID in 2018, when the Fed tried to raise rates from a low level and had to abort it very quickly when the wheels started falling off the bus in the fourth quarter of that year. So you look at the difficulty the Fed has had in normalizing rates, and look at the recessions. And in fact, in 2008, 9, that was the Great Recession, when the Fed tried to normalize rates after keeping them at 1% for a year and a half or whatever it was, and then slowly normalizing rates back up above 5%. That produced the worst recession since the Great Depression. So why would anybody believe that the Fed can normalize rates now and not have a similar consequence? Because after all, the rate hikes expose all of the malinvestments, the misallocations of resources that take place when rates are artificially low, right? The Fed keeps rates artificially low, and that causes consumers, investors, governments, everybody behaves irrationally based on an environment where interest rates are too low. Decisions are made, investments are made that are not really supported by the fundamentals. Now, if interest rates were low for natural reasons, for reasons having nothing to do with the Fed, how would interest rates be low for natural reasons? Well, they would be low if you had a lot of savings. If Americans were saving, you had a huge supply of savings, that would mean there'd be a lot of funds for people to borrow. And if there wasn't a lot of borrowing going on, if consumers were buying stuff for cash and not using credit cards or other forms of debt, so you didn't have a lot of borrowing and you had a lot of savings, and of course you had low inflation, because low inflation is also important. If you had all these factors, and when people are saving, if Americans had a high propensity to save, that would mean that they don't want to go out and spend. They're delaying their consumption. They're saving instead. And so the time preference for money is affected by that. And so because people aren't spending and they're saving their money, that means there's money available to finance long-term investments so that businesses can borrow money to build a capital that will produce goods in the future when these frugal Americans are going to tap into their savings, right? So when you have Americans preferring to consume in the future rather than today, you can have low interest rates in that environment. But that is not the environment that we're in. There are no frugal Americans. We're living for now. Everybody is profligate. Nobody cares about the future. People want to buy stuff right now. Nobody wants to wait. They want to buy now and pay later, or buy now and pay never. So we don't have an economy that would naturally have low interest rates. And if you naturally have low interest rates, then the decisions that are made and the investments that are made can be supported by those naturally low rates. But when you don't have that, when you have rates that have been manipulated by a central bank, initially, the people in the economy, the investors, consumers, they don't know the difference between interest rates being low for natural reasons or artificial reasons. They just react to the low interest rates. But because the low interest rates are artificial, they can't last. And so unlike a situation where rates are low for legitimate economic reasons, where the investments based on those interest rates can be supported long term, when they're artificially low, they can't be. So all those mistakes are made because rates are too low.
Thanks for tuning in to this insightful analysis by Peter Schiff. Don't forget to like, subscribe, and share your thoughts in the comments below. Stay informed for more thought-provoking discussions on the economy and finance. Until next time, stay curious and stay ahead.